Hello, everybody, and welcome back to the M3 Market Update. My name is Melody Wright, and I do this show to give you context around the information we're receiving for commercial and residential real estate out in mainstream media. And I do that because we are riding on a wave of narrative recently, and it's important to triangulate the data that we're getting to get a real sense of what's going on out there. I also have done boots on the ground, as many of you know. I go out to cities and look and see what's happening in front of my very own eyes, because what we've found is that the data just does not paint the picture. So, welcome back. It's been a minute for the M3 Market Update. I hope you did check out my new series, The Forgotten American. I had a great conversation with Marley Price, a local hero, in my opinion, from St. Petersburg, Florida, who has been responsible for bringing 23 illegal short term rentals to the market. And so, very interesting story to hear from someone so young who really legally and productively took matters in her own hands when it just simply became too unaffordable in her community because so many people were coming in from out of state to set up illegal short term rentals. So I hope you check it out. This series is really about giving people a voice, giving you a voice, and feel free to reach out to me if you think you have a story I want to hear. And I love stories. So it's just going to be regular Americans every week and not just the economic luminaries that we often see on YouTube. So glad you're with me because I have some breaking news today. I have to be honest, it was even a little shocking for me, but we have seen a 13% increase in delinquency month over month. This is the largest increase in delinquency month over month we've actually seen since those early days of COVID, since April of 2020, when we just had those over 100% month over month. So this is shocking. And the biggest component of that is going to be your 30 plus delinquency. And before I kind of show you that chart, I just want to talk to you about why 30 plus delinquency is so important, because that's that new delinquency. Well, in the United States, we are all obsessed with our credit scores, our credit reports, because it impacts what kind of credit, what kind of interest rate that we can get. And so we know, most of us, that if we pay something 30 days late, that is going to ding our credit. And it's an impairment. It's going to make it harder to do things like refinance. It's going to make it harder to buy a car. All of those types of and it could mean your credit card rates go up. And so 30-day delinquency is a big deal. When you make that choice, it means that you have no other choices to make typically, unless you just, billionaire who doesn't care about their credit. But then why would they take out a mortgage? Maybe because we're all hyper financialized. But for those of us who have to operate in the, in sort of the regular realm, that is a significant event as when we see our credit score deteriorate. And so we've had a 19% month over month. I'm just going to repeat it because it's crazy increase in 30 plus delinquencies. Now, I'm going to show you the chart here. I'm going to share my screen. Give me 1 second just to show you what this looks like. But if you want to go back to the crisis, the last time we saw this kind of jump was actually between August of 2007 and September of 2007. And, the recession was called in December of 2007. So you look at this little uptick here, you can see this is going in the wrong direction, and it's going significantly. Now, while you're looking at that, I'm going to talk quickly about where this data series is coming from, because as you guys know, it's important where the data is coming from. So this is the Black Knight series. I have been looking at other sources that have told me that delinquency was much higher than what we were seeing. But that's because of the sources. You can look at Fred does a mortgage delinquency, but that's for all commercial banks. It's not the non-banks. Since the crisis and because of Basel III, many banks kind of scaled back their lending. And so now the majority of mortgage lending happens in the non-banks. Now the banks got involved, back during the COVID boom because something called the leverage ratio was suspended, the SLR. And so they came in and they played because it just had become, since the GFC, far too costly to hold those assets due to the way they got risk weighted and impacted the leverage ratio. So non-banks are not tracked by the Fred by Fred. Now, Black Knight has banks and non-banks, but it's important which ones they have. They're the biggest servicing software. Now, what is a servicer? That's who's taking your payments. That's who's doing the administration on your loan after it was originated. You may, if you've taken out a recent mortgage, you probably got a letter very quickly after taking that mortgage saying your loan was being transferred somewhere else, and that was to your servicer. Now, you do have some originators who service as well, but a lot of times it's going to be transferred. And so the type of servicer, if in this business, if it's a delinquent loan, a lot of investors want it at a specialty servicer, and those are servicers that really specialize in delinquent loans. Well, Black Knight has a lot of servicers on their system, but not many of the smaller specialty servicers. Um, there's one called FCI Lender Services from Inside Mortgage Finance. We know a couple of months ago they had a delinquency of about 30%. They primarily service the private note space as well as, again, those delinquent mortgages. So very high, but that's not something that's going to show up in Black Knight's numbers. And so we've seen in the census household pulse survey higher delinquencies as well, but it has not shown up in the Black Knight data. I've seen it in my client books. We're finally at a point where it's showing up in the Black Knight data, and that month over month leap. I cannot wait to see how they're going to manage this message. My first thought was maybe they added a large servicer, but in looking at the count, that does not look to be the case. And so in reality, I think the only thing that I know right now, we won't hear from Black Knight for a couple of weeks, because this information was shared with me from their institutional product. So I'm very curious as to how they'll manage the message, and maybe there is something that I don't know about. But with that 30, I mean, it was in every 30 plus, 60 plus, 90 plus, 120 plus days, every one of those categories saw an increase in delinquency this month. It seems as if the consumer has finally had enough of inflation. They can't stomach the increased property taxes. They can't stomach the increased insurance, which is just out of control. And guys, with what happened in Houston, we're probably going to see another month of delinquencies spikes as well. So I think that we are at the point where folks are not going to be able to point to mortgage anymore as the asset class that is, we're seeing it in autos, we're seeing delinquencies in credit cards. It's official. We are seeing it in mortgage as well. Now, I still believe there are so many programs out there. I did a deep dive over a year ago into loss mitigation, and those are the programs that are out there to help borrowers. So there will be plenty. This is going to take a lot of time because as these borrowers move into delinquency, they will then be reviewed for a loss mitigation solution. And in fact, Freddie and Fannie have just come out with a new program that's essentially you can get up to a 20% payment reduction depending on certain qualifications, what your loan value are, things like that. I'll be talking more about that program soon, but there are plenty of programs that will help these struggling borrowers. Except, let me just say, we're going to move over and talk about FHA delinquency. FHA delinquency is right now at I mean, it's very high. From it 13% when you look at it. I'm looking at this graph right now though, and I'm sorry, that's why. A little, I think sickness has hurt my brain. This is the 30 plus only, but all delinquency for FHA is at a 13%, 13%, more than 1 in 10 borrowers. And the thing about these FHA borrowers is that they've already done their what's called the partial claim. They've and essentially what happens is all those months, that 18 months of forbearance, that they could put it on the back of the loan to be paid off when they sell it or pay off the loan. So they've done the 40-year modifications. They've done joint partial claims plus 40-year modifications. But I can tell you absolutely, those 40-year modifications are not helping. They're not saving anybody when I'm looking at this in my client books. But the 30 plus delinquency in FHA is also ticking up. And so, this is, if you look back historically, you think about who the FHA is. And a lot of people, when I show these charts, say, well, it's not that big of a deal. It's not that much of the market. In reality, it's about 17% of outstanding mortgages, and that has doubled since 2009. And this is truly government subprime. These are 580 credit scores, 620 credit scores, low down payments. And so this asset, the FHA product, we are definitely, I believe, going to see even more delinquency. But this is just so concerning, guys, at the levels that we are currently at. And these borrowers don't have a lot of options if they have a job loss. Or if there's some sort of repair that they need, it is going to be very meaningful to them. And then just taking a look at overall mortgage delinquency, total delinquency. So, we saw this huge month over month really spike back in 2020 when COVID was just announced, a very sharp increase. But to say this is the largest increase since then, this is big news. And now these numbers are low, still low in this series, around a 3.94% total delinquency. But the trend is what matters. The fact that we've got all this new early delinquency is more concerning than even late stage delinquency increasing. Now, as I mentioned, it takes a lot of time. Since Dodd-Frank or the CFPB, you have to wait until you're at the 120th day to refer a loan to foreclosure. So again, my argument here is not that we're going to have a ton of foreclosures hitting the market. That is just not what's going to happen. When we get to that stage, the state attorney generals will get involved. There'll probably be another federal moratorium. The moratorium for VA, for instance, expired in May, but they're trying to extend it. So there will be moratoriums as we get this delinquency. But my contention is that there's so much investor activity, and they, a lot of times in these cases, they walk away, and so that's where we'll get primarily actual foreclosures. But that still also takes time. These engines, the way this works, if somebody makes a payment, everything restarts. You have to notice. I think I told the example of I had a client who had a vacant property. Those are supposed to go very quickly through the process, taking months to get it referred to foreclosure. So there's so many things that can stop this. But I think by this time next year, we will have a meaningful delinquent population. So this is for a geek like me, this is a big moment, and I'm still kind of in shock about it. And I'm kind of processing it with you, because you just don't see these types of month over month jumps. Okay, so what else is going on out there? Well, we're going to have Redfin updates here soon. I'm hoping today, actually, that I'll be able to capture that information so I can forecast what existing home sales have done. But we're hearing that if you read Zelman, what it looks like on the new home side is that traffic increased a little bit, as did incentives and buy downs. So I think that, based on those terrible results the builders had last month, that probably people kicked it into high gear. Lennar recently, in its 10Q, released the amount of incentives it was using on average in each state. I wish I forgot to bring that up, but I mean, in one state, it was around $81,000. I think that was either Florida, and Texas was around 50,000, or that might be flip. But put it this way, guys, they're using huge incentives. And so they are going to win. Against existing home sellers, and they have to. They're moving product versus, individuals, although we've got some institutional selling for sure. But individuals who might have different options are they can take longer. The builders have to move this product. We just also saw that builder sentiment take down another point this month as well. So, the builders are in pretty rough shape, and they have a ton of supply coming. On the existing home side, we're hearing it sounds like early results seem to say that things were slower. So that will be fascinating to see if we actually peak with home prices hit another all-time high, because June is that peak typically in the season for existing home prices. On the new home side, that peak is typically in May. And so we saw prices go down month over month for new homes. I believe we're probably going to see that trend continue. And I think that as we round the corner, we hit August, it's going to be a really tough housing market, as if it wasn't already tough. But I believe we'll probably start tracking similar to August of 2007. And, I mentioned the last time when you go back to the crisis and you look at, okay, during the run up to the crisis, when did we have such a significant increase in 30 plus delinquency? That was in August of 2007. So I think things are developing. I feel that we have there definitely the consumer is, I think, at an exhaustion point. And I think when we saw in the consumer sentiment that low income and income were starting to track in their sentiment the same way, that's when you knew it was moving up the K to the middle. As well as I think the super prime are coming under stress. A very interesting article in I believe it was a real deal that went through this big guru who was responsible for really getting people into multifamily older buildings. It was just so basically he would bus people around cities so they could find older multifamily buildings to purchase. Well, as they couldn't increase rents, as they also had increased property taxes and insurance, the carrying costs just became too great. And so I think our super prime, our doctors, lawyers, things like that, they are also coming under stress. These limited partners in these multifamily syndication deals. And so I think what you're seeing is stress at the top, stress at the middle, and stress at the bottom. And so we are, I think, pretty soon, there will be no more questions about where the economy is headed. And the other news that we got this week or last week is that the CFPB is looking at some new proposed rules. Honestly, they're just aligning more with what already happens. Nothing too earth shattering there, but just more red tape. I did a show. I'm not sure. Some of you may not know that I recently also have been involved with a venture. It's called Doomers News Network. But I did a show recently on an important Supreme Court decision, the overturning of Chevron deference. And that is going to take the teeth out of the CFPB, or the Consumer Finance Protection Bureau. So, I think every time I talk about anything in housing or mortgage out in social media, everybody is very quick to say, well, the government will bail out. So. Well, a lot of those powers and a lot of the things that people like the student loan forgiveness, the way that they've been doing that is skirting through this deference. So that has been overturned. It's going to be harder to do those types of things without congressional action. So it's going to be very interesting. So I cannot wait to see June results. I think it's going to tell us a lot. We will have, I think, new home sales and existing next week, but I should be able to give you an idea of where we're going for existing on Redfin. So I hope everyone had a wonderful fourth. I hope that you're enjoying the last days of summer before school starts. It's it's days like this that really, make me very glad that I've been tracking this information for this long and that I have all this data because this is a true inflection point for the consumer. Does it mean a lot more foreclosures? No, not necessarily, not for some time, but it tells you what's going on with the consumer. Okay, guys, thank you so much for joining me. Again, I hope you're having a wonderful summer. If you need to reach me, you can reach out to me at M3 underscore Melody on X Twitter, M3 Melody Substack, and here on YouTube. Thanks again, and I'll talk to you soon.